So welcome to the Red Chair. Today we have Bjorn Tremmerie from the European Investment Fund. Bjorn, welcome to Indico. Great to see you in Lisbon again.
Yeah, thank you for having me here on the Red Chair. Red Chairs even.
Exactly. It's so good to see you. So you represent the European Investment Fund. We'll talk about that right after. But who are you? Where did you come from?
Yeah, despite the Scandinavian, I was looking at the name tag because we're at the Web Summit here as well, and I don't have it. But despite the Scandinavian first name, I'm actually Belgian. Grew up in Belgium, the Flemish-speaking part, the Dutch-speaking part. Studied in the French-speaking part to get some French knowledge, and then did some studies in Germany as well, the third national language of Belgium. And then very quickly I wanted to have an international career. Went to investment banking, then went to direct investing, venture capital, worked for a Belgian-based, globally active VC fund.
Which was?
Flanders Language Valley Fund.
Right.
It was listed on what was then an attempt to create a European Nasdaq, and that attempt was called EASDAQ.
I remember
these. Flanders Language Valley Fund was a fund with $200 million plus listed.
Which was big at the time,
At the time, yes.
Which year was this, more or less?
Oh, it was set up second half of the 90s. I joined in 2000. We had just done a secondary public offering, $90 million on EASDAQ, and I was recruited to help the then already existing team to invest that money. And we were already looking at the AI at the time. We were sitting next to Lernout and Houseby, the speech rec company that one day at the heydays of Nasdaq was valued a couple of billions as a Belgian company.
In the dot-com boom.
And the dot-com, yeah. And
then you joined, and then there was a bust, right?
And then I joined, yeah, we had even ESOPs. So we didn't have carry at the fund, but we had stock options. And I had a strike price, and since I joined, actually, we never made it above the strike price.
No.
It only went down. My shrink told me it's not my fault. No, that's a joke. But no, it only went south after that. And a certain moment in time when you're trading as a listed company below the money on the bank account, yes. And you have a portfolio of 40-50 companies, and we had Shazam in the portfolio.
Oh, you had Shazam already?
Yeah. We were the first round investors together. It was then called Lynx, a joint venture between Bear Stearns and Virgin Media. Mm-hmm. We had IDG Ventures in that group as well. And we had 40-50 other good companies still with the benefit of hindsight. But we were not appreciated enough on the stock market. We turned the money back to the investors, sold off
all the shares.
The shares in the secondaries. Most got preempted, by the way. And some were decent companies that are currently still alive. Shazam as part of Apple now, so many years later. But there was a moment in time that I was also let go. I didn't have a portfolio to manage anymore, and EIF picked up my CV.
And the EIF was kind of just starting in a way, right?
I think we were 4 or 5 years into a real, 6 years maximum into a real fund investment. But it was kind of small, right? Well, I think we were less than 60 people when I joined. With a guarantee activity, with already venture activity.
This is at the beginning of the 2000s? Or?
2002. So I joined Flanders Language Valley Fund May 2000, and I joined EIF October 2002.
And so tell us, what is the EIF and what were they doing at the time?
Yeah, EIF was then already doing exactly the same thing as today, but at a different scale. EIF is the financing arm of the European Union for innovation, entrepreneurship, SMEs. We have 2 product lines, a credit product line where we give guarantees to banks so that they take a bit more risk to startups or to tech companies or to SMEs. Mm-hmm. In the case that they are too afraid to take the more risk that it's going to generate losses, we're willing to, against the guarantee fee, guarantee some of the losses. On the equity part, where I am, we do investments in funds, venture capital funds and lower mid-market funds, development capital funds. We invest in the meantime between 4 and 5 billion per year on the equity side, of which 2 to 3 billion on the VC side. Nowadays. At the time, it was a couple of 100 million.
Yes.
So the scale has dramatically changed. But already at the time, to invest 200, 300, 400 million per year in SMEs, you don't do that directly, or in startups. So for that scale, we went an intermediated model. We don't invest directly. We invest in funds, or we give guarantees to banks or credit institutions. That's basically what EIF does. We're fully fledged in terms of set up. We have an in-house legal department, in-house risk department, in-house compliance department. We have a top-notch back office department as well. Given that we have so many mandators, we need to do certain elements in-house. What we can outsource, we try to outsource, of course. But when you have more than 100 mandates to serve, there's a big institutional back office we need as well.
When you say mandates, what does it mean?
A mandate is... our money doesn't grow on trees either. So
where does it come from?
Where does it come from? Good question. So in order to be able to invest in people like you at Indico, we need to get money somewhere as well. We have what we call 4 pillars of money providers. But before I go into the pillars, let me first explain the cap table, because it's 2 different things. We have shareholders and we have mandators. Our shareholders are typically 3 groups. The largest group, it's just one party, is European Investment Bank, 60%. Second group, the European Commission, 30%. And then a group of 30 public and private institutions for the remainder of the 10%.
Which are shareholders?
Shareholders of a cap table of 7.4 billion, roughly 20% paid in. With that cap table, which is AAA rated thanks to our ownership, the EIB and the EU member states, we can then attract money. By the way, we're the only public European institution that has also private shareholders. So we're a public-private partnership, and everything we do has to happen with a profit purpose. So we're not a grant institution. We are there to support policy whilst making money as well.
Yes.
The only thing, because a lot of what we do is policy-driven, the only thing that sets us really apart from the pure private sector is we don't need to pursue maximization of profit.
Right, but
then
you need to be profitable.
We need to be profitable, and
so that's why you are super demanding.
That's why we are. That plus the fact that we also manage 90% of our shareholding are linked directly or indirectly to member states, and a lot of it is public money. So we have a duty of care towards that. I don't think the private sector can gamble either, but we need to be super careful that
but you
public
do have
money
private
is well
money as well, right?
Yes. So both in the cap table, but now finally to your question, where does our money come from? Because our cap table money is only 20% paid in, 20% of 7.5 billion is not going to take you a long way if you invest billions per year. Largest shareholder is also the largest mandator money provider. The EIB has entrusted us with an evergreen mandate that has grown to 16-17 billion. That allows us on an annual basis to invest more than $1 billion into European private equity and venture capital funds. Our minority shareholder, European Commission, entrusts us with money. It's the second pillar of money provision. Entrusts us on an annual basis, on a 7 annual basis, with budgets out of the 7-year multi-annual programs, the European Union budgets. We're currently investing out of the 21-27 period. Before that, we had Horizon 2020 with Innofin and Cosme. And those programs are tailored to regions, are tailored to sectors, are tailored to stages. And it's also in the magnitude of a couple of billions over the 7-year period.
Innofin, by the way, was the mandate that created Indico, really. I mean, invested in the first fund.
Exactly. And the mandate of Innofin is also to put new people in the market. We need more venture capitalists. Also in the markets that are historically not known to be the markets where innovation is happening. And that is changing rapidly now, thanks to you, thanks to the programs that we have. The third pillar of money that we manage is coming from member states, accession countries to the EU, or from regions in the EU or a group of member states. So in Portugal we have programs Portugal Tech, we have PVCI, we have Portugal Blue and Growth. We have similar programs in Spain, we have similar programs in the Baltic states, we have programs in Sweden, in Eastern Europe.
And this is money from the member states that you manage,
that
basically.
we manage on their behalf.
On their behalf,
yes.
With your technology, with your knowledge.
With our know-how, it is money that say sometimes then they go on and build their own
of course.
Teams.
It's a partnership.
It's partnerships, and we help them grow as well. In the meantime, I think, for instance, the largest mandate that we have there is a mixture of mandates in Germany, where I think in the totality of the money we manage for Germany, It's close to 8 billion. In the Netherlands, it's grown to over 1 billion. I think we have repeat programs in Portugal as well, where perhaps it's not to 1 billion, but we also have a couple of programs where we're closer to 500 million than 200 million. So some of these partnerships work very well. The good thing is European performance has been such, both on private equity, but increasingly so on venture as well, that it's very difficult on a portfolio of funds to lose money. So we're profit making as per our mandate and our cap table on all of these mandates. So it is a product that works well. Member states and even the EIB and the Commission can entrust a large pocket of money. They know that statistically the chances of losing that money is close to zero, and that the chances of actually getting returns that are better than what you can get for inflation adjusted returns in the market is something that everybody likes. Then we have programs as well, and then I come to the fourth pillar. It's programs where we have private money providers, pension funds, insurance groups, family offices that really say, dear EIF, you are so well enshrined in the European private equity and VC landscape. Why can't you give us a product that of everything you see, you give us access to the best of the best? Then we also have private clients, which are corporates that say, I'm not interested in maximization of return, but I'm actually interested in getting a knowledge of everything what Europe has to offer, also in the lesser developed regions. I'm willing to take a lesser return, but you give me a bit more visibility on what's happening in Southern Europe, Eastern Europe, or in other markets, even in developed regions. I want to see what's happening in space. I want to see what's happening in life sciences. I'm willing to give up some of the upside on the return in favor of getting visibility on the total market in Europe, in a segment or in a region. And that's when corporates sometimes team up with us as well.
Right. And so let's go back a little bit in history. So in 2002, we were really, in the lowest point ever, probably until today.
Yeah.
And it was actually much lower than what we have today. So, and then what happened? We had like the nuclear winter of venture capital. What did that mean? It was right after the dot-com boom, bust, and then you had money to invest in funds. What were you thinking back then?
We already had the money. So since 96, 97, we have made our first fund commitments. We were all hyped up because we had the dot-com.
Right.
Wow.
Great returns until 2000.
Yeah, and then everything stopped. But it's basically, we took baby steps into the market in Europe. And then our feet and our legs were cut off with the dot-com crisis. Many people burned their fingers. Many people learned hard lessons, and some of those lessons have to be relearned now. We can come to that if you want. But what happened then is that basically the market came to complete halt. I like you're saying the nuclear winter. I think in 2003 we didn't even invest in 5 VC funds in Europe because hardly anybody was capable of raising.
Yes.
People were looking what was happening, the hemorrhaging in the portfolio. There were people that were never bouncing back from it.
No.
Because
there weren't that many funds either, right? I mean, there were some, but not that many either.
Well, late 90s, there were years where you had...
Many appeared.
Appeared, but it was really one-hit wonders or...
Yes. But compared to today, there were very few funds. I mean, I was in London at the time. I went through the dot-com boom and then bust. I was already at Harvard when the bust happened. Yeah. But it was really small. I mean, compared to... The hype was similar to these last few years. Yes. Maybe even worse. But you could also see that back then. I remember in 99, you could see that things were going to go off the rails at some stage, right? And they did.
Well, it was my first real boom and in my career and bust, so I was inexperienced with lessons learned and with trends. But I do think that people that have been at that time longer and had witnessed other cycles, they probably had seen the first time of greed at the top and then fear at the bottom, and the psychology of how markets behave whenever. Now we know, or we should know, that when everybody says it's time to buy, it's actually the time to sell. And when everybody says it's time to be fearful, then it's time to show courage and to invest. Right. I didn't know that at that time yet, so it would be a bit arrogant to claim now that I knew. But what happened really is that the markets came to a standstill. Now, what I really like about, and personally I don't take credit for it, but I think our mandators, the Commission, our shareholder, and EIF itself, is to be credited that they didn't ditch the future. They were courageous enough, but also foresightful enough to say,
long term,
we need to invest in venture capital, because technology ultimately is innovation, is what's going to create jobs. It's what's going to drive new companies. We cannot ditch this. Even when pension funds say we're never going to touch this again, when insurance companies and institutions say
said for many years.
Never again in Europe, they said we've burned our fingers so badly. And again, performance then was bad enough that I can understand. But so what happened is that basically we had to create a phoenix from the ashes. But even a phoenix from the ashes needs to have somewhere substance to rise again. So we and not only EIF but other public institutions fueled that ecosystem. Happily, there were nevertheless, despite the hardship, there were nevertheless people that were courageous enough
Believers.
To still be an entrepreneur, that say, I don't care if it's a mission impossible, I'm nevertheless going to try to build a company, a startup. I have a good idea, I believe in myself. And we started to see the first people really creating successful companies. And it's a bit a pity that nowadays, I need to still mention it, but there's plenty of other examples, but nowadays a number of companies have created a momentum of, hey, it can still be done. I still remember when Kelco was sold for 500 million to Yahoo at the time. In the French ecosystem, even the European ecosystem was like, wow. Then Skype happened, 2 billion exit to eBay. It was like, wow, in Europe. And you had Love Film, you had other success stories. Perhaps not all of them come to mind now, but that created the first momentum of, hey, something's happening here.
And a lot of great companies were created back then. Even in Portugal, I mean, the Feedsai, OutSystem,
they were already
in those times.
But the outcome wasn't visible then yet.
No.
It was also the time, people don't know this, but Booking.com.
Yes.
Booking.com was created in Amsterdam. And it didn't need 100 or 200 million fundraising, but needed a growth round. That was a bit tougher than expected. And all of a sudden, I think one of the Marion groups, was it now Priceline, made an offer, 150 million, and they bought it.
Suddenly, then we had the global financial crisis, which kind of damped things a little bit. Or what do you think?
In between, we I think before the global financial crisis, I think we need to mention a couple of groups. Rocket Internet happened, Berlin, out of nowhere. They may have been copycats, what have you.
But it started.
They have played a major role in European venture. I think Team Europe as well. In London, there were a number of groups that last minute .com. You had Brent Hoberman. You had a whole ecosystem there, and then Founders Forum. Then indeed the global financial crisis happened, but it didn't lead to nuclear winter.
No, the same way it had in the past.
So already there was a bit more belief in the startup community with founders that
the mobile revolution was ongoing, right? And the start of the cloud revolution, right?
It was already. We're never going to go back to the nuclear winter. It was really, EIF couldn't. I cannot show 5 companies in my portfolio vintage 2003. Yeah. And roughly the same 2004. So if they ask me for statistics and I show a top 5, I cannot go back to 2003 or 4 because I don't have a top 5 to show. No. I only have perhaps a top 2 or 3, and if people look in our annual reports who we backed, people might get the performance of those, so I cannot disclose the data because it's so slim. Back to the global financial crisis. Even in the global financial crisis, Sequoia sent out their deck, RIP, Good Times. Mm-hmm. And I like that a lot because there was this famous email that Mike Moritz or Doug Leone and Mike Moritz had exchanged. It's actually a double email. First on what he had sent in the 2000 .com crisis to portfolio companies. Yes. And then he said, I'm going to dust it off again now because it's still valuable. And with the benefit of hindsight, I thought European VCs, and perhaps I'm I'm being a bit too harsh for them, but I think in Europe the VCs didn't really have a clue what to do in hard times.
Right.
Mike Moritz said, make certain you have 12 months of cash, and if not, be prepared for a tough ride and try to find a consolidator.
Right.
The power of negotiation has changed in favor of investors. So you, famous entrepreneur, if you thought you had the power balance on your side negotiation-wise, think again. That is not happening. But then we started seeing that after the global financial crisis, we've had the sovereign and the euro crisis. European investors were already a bit more agile, and fast forward a lot comes the pandemic. Immediately, all my managers said, "This is the exposure of my portfolio. These are going to suffer. These are neutral, and these are going to win." We immediately had that. Then you had the Ukraine invasion by Russia, you had the gas crisis, interest rates rising, really crisis at global scale. If you have the CEO of JP Morgan saying that this is the worst time since World War II, immediately had again my portfolio manager saying this is what's happening, SVB collapse, this is the exposure we have. Immediately we have now an ecosystem, we have GPs, we have founders that are reactive, that know what to do, that are on top of things, and that's how I see it.
The level of sophistication is nothing to do with what it was, right? Not only the level of sophistication, but the level of capital. Pretty much everything is totally different. So basically, we are now in a totally different situation. But didn't you see already, maybe also in 2015, that things? Because I remember we were worried. Actually, in 2015, even before Indico, we were like, "Oh my God, valuations are going through the roof already." Then there was a bit of a slump, and then it's kept going up and up and up. And when we launched Indico, we knew we have to get into the market fast, because there's nobody in the Portuguese market sort of covering it. We got you on board, thank God, and it was super difficult to get other investors, but finally with your seal of approval and a few other believers, we got it, and we invested a lot in 2019, which at the time was a bit weird for some people, but we thought we rather do it sooner rather than later, because things will derail at some stage, as they did.
As they did, yeah.
And we actually sold a unicorn when it reached unicorn status.
Well done.
And now it's no longer, I think, a unicorn. And so basically, here we are now in a totally different situation. But people have learned, and the system is resilient. What do you think are the big differences now between VC managers? We'll get into regions and differences, but in general, VC managers 2023 versus 10 years ago.
I would even say 10, 15 years ago, I would say that the VC managers, the mix has changed. We have people that now also have learned to become a VC from the operator point of view. So we've added founder experience, operator, entrepreneur experience to the mix. I think that helps. I don't think it's the only ingredient, but if you look at many VCs in the US,
have that.
They almost exclusively have that. We had the experience from the late 90s, when the only VCs, they were people coming out of investment banking or consultancy. We didn't have yet role models that successfully said, I've sold a company, I've created a company, sold it, I'm now a business angel, and on the basis of a business angel track record, I'm going to be a fund manager. Yeah. Now we have plenty of that. So that to me is if not the most crucial, it's at least a very valuable element to bring to the mix, that you know what it is. You have that on board in your team as well, with some people as with Christina. So I do think that that completes the picture. Is it the only way? No, because we see as well that there are the people that are still here and that survived the dot-com crisis. They must have done something right, even without the entrepreneurial experience, or in the meantime they have brought on board that expertise. But I think the mindset has changed both at the entrepreneurial level and at the GP level. At the GP level in the 2000s, I had the feeling 2005 period that people were happy taking on board our money and not lose it, because if you didn't lose it, you already were top quartile.
Right.
But you're not going to attract the real institutional money with that discipline. You need to be able to have more ambition than that, and to see what do I need to do to get really the 20%, 25% net returns that I market. What do I need to do to get there? And then you also need to team up with the right entrepreneurs that have the ambition level. And there we start having the right entrepreneurs. on board that are not selling out too easy, like Booking.com, but say, look, yeah, I think I have something solid here and something valuable, could be a global player, let me build that out further. So that entrepreneurial talent at scale, and the GPs now also seeing that, yes, you can scale it further and not sell out too early, or at least not sell out completely too early.
Right.
That we have seen. But I do think that the main thing is experience. It's not that all of a sudden
it takes time.
People have been drinking different tap water or so. It's just the ecosystem has built the snowball effect of entrepreneurs turning serial entrepreneurs turning business angels turning fund managers has really kicked off.
Right. And did you see? I mean, of course, then now it's no longer just Berlin and London. Did you see the emergence of other areas, and how do you think this is going in terms of these peripheral regions which traditionally have nothing, and now something seems to be happening?
We observe that everywhere, but there's a good study that Deal Room together with Axel that everywhere where you start seeing a success story, it can be unicorn, but it doesn't even need to be a unicorn. Everywhere where you see a success story, it opens the eyes that entrepreneurship can be successfully done. It creates awareness, and the snowball effect of success breeding success starts. I still remember at the smaller scale the effect of in Spain they called it by BIP, by VIP, being sold. I think it was sold to Amazon for not even 100 million.
But it was like,
but it was the talk of town.
Yes. It's like here Farfetch and Christina's Talk Desk.
But that's Farfetch is already unicorn level. Yes. But if even $100 million dollar exit creates that type of buzz, imagine what unicorns do. And now you have unicorns in Portugal, tune 5, 6, 7. But everywhere where you see a success story, UiPath in Romania, Viva Wallet in Greece, in the regions where people would not expect it 20 years ago, you start see this snowball effect taking place, and everywhere. And that's the big difference with the US, where a lot is still concentrated in the big hubs, Silicon Valley, Boston, Austin, Texas, New York. But here in Europe, it's really coming from all over the place. And it's this hub phenomenon. So I would say Lisbon, a couple of years ago, I think 2018, was one of the top 5 cities where people wanted to set up a company. And it has only increased now, digital nomads during COVID, the good weather, but the tech talent that you have, the engineering talent, the good English knowledge that you have. Mm-hmm. You see that here, but in the Baltics as well. Yeah. Tiny countries, but man, innovation hubs. So really everywhere.
What is it missing for the private capital to come in force? Because everybody is so dependent on local institutions and institutions like yourselves, which are great partners, but we need also the private capital in these peripheral countries.
I'm still a bit without a real answer. I do think 2 things. It's personal views. Despite all the good statistics that we can show about European venture, that we're at par, at least with paper values and net IRRs with the US. If you tap into the best, the top 25 in Europe can rival with the top 25% in the US. And there's data that underpins that. What I do think is that we don't have a long enough history, because a lot of those data points are based also not only on realized, but also a lot of unrealized value. I think the real money will come if the institutionals will start seeing that it's cash on cash returns as well. Right. And I think we don't see it enough yet at scale. Mm-hmm. Mm-hmm. And to me, it's a matter of time, and it's frustrating to have to wait. But you cannot speed that up. I do think now that we show it on paper, there's always the doubting Thomas that will say, but I also want to be able to touch it, to feel it. Absolutely. And that's then the cash on cash. And there, unfortunately, even I, as a big believer in European tech, have to say that sometimes we don't have it at scale enough yet. I start having funds that have cash on cash returned 5 times, 10 times, 14, 15 times. I have that in my portfolio. Yeah. But do I have 50 examples of 10x funds? No.
No, not yet.
I think not yet, definitely not yet. But by the time that I will have the 50 fund managers that have 5x cash on cash returns in their portfolios, or at least one fund, that's the moment where all the institutionals will say, we'll get in.
Yes. well, we're all waiting for that day, and we'll all be very happy. And thank you so much for your support. Thank you for coming to our offices.
Thank you for having me.
Good to see you again.
Thank you.